It's going to be a packed session, and I'm really excited to be here. I'm Lex Sokolin, head economist at ConsenSys, and we have with us a fantastic panel of practitioners, and both on the finance function side as well as on the blockchain side. And so I don't know in which order the windows are on your screen, so you'll have to bear with me. But we'll start with we've got with us Sendi Young from Ripple, who's the Manager Director of UK and Europe, Richard Stones of Parity Technology, who is a Finance Director there, and Quentin Ricomard, who is the VP of Finance at Ledger. And so with that, we'll do a brief round of introductions about what they do, their company, their background, and hop into the basics of our topic. So maybe, Sendi, we'll start with you. And then go to Richard and Quentin.
Great. Thank you very much. Pleasure to be here today. Really exciting panel and great conversation I'm looking forward to. So, so I'm Sendi Young. I manage the European region for Ripple. At Ripple, we essentially help companies move money more efficiently, cheaper, faster, transparent, and effective way around the world using crypto and blockchain technologies. Particular to the topic of obviously this conference and this panel today is we've been seeing a tremendous amount of interest from treasuries increasingly around using these kind of solutions for treasury operations, and I'm really excited to talk about some of the pros and cons and the opportunities out there. Thank you.
Yeah, morning everyone. Good to be here. So my name is Richard Stones. I'm at Parity Technologies. I'm the finance director. I've been in crypto for about the last 4 years or so. Prior to that, I was went through banking. So I've got a good mix of traditional finance and obviously decentralized finance now. In terms of my experience, I wanted to search for something new, look at the new technologies, obviously blockchain, cryptocurrencies, what they had to offer. I went through a company where we were one of the first to get regulated in the UK and listed on the UK stock market through an IPO, and then obviously moved on to Parity Technologies, which I'm really excited to be here, working with Web3 Foundation as well. We're looking to obviously what Parity does is help build the blockchain for Polkadot and Kusama. So those are our two key tokens that we have on the blockchain. I'm excited to talk about it as well in more detail, but that's me in a nutshell.
Thanks. Hello everyone, and glad to be here as well. So Quentin, I'm running finance and data for Ledger, being in corporate finance for 15 years now, and in crypto and Web3 for more than 4 years at Ledger. What do we do at Ledger? We are a tech company that allows consumer and financial institutions to store and manage their crypto in a secure way through an hardware if you are a consumer, and through HSM and secure server if you are a financial institution.
Fantastic, very efficient. So it's hard to know where our audience is in terms of how deep into understanding the sector they are. So if I can just paint with a broad brush, we have actually a really great representation here of different parts of the industry, different points of view, and I'm sure I'm going to mischaracterize, but with Ripple, we have a deep understanding of payments networks as well as the enterprise blockchain space, and the traditional company view of how to plug into crypto assets. With Parity, where we have the experience of live on-chain kind of emerging protocols, so big computational networks that are running software, often DeFi software and NFTs and so on. And then with Ledger, we have an understanding of how to hold the assets, how to actually custody them, what's the technology layer around the assets, and I'm sure, of course, much more. So three quite different places from which to look at the industry. And so that gives us a transition to understanding the basics. Again, assuming that, if you're in a traditional company and you're focused on the finance function, it's, unless you're personally passionate, maybe you don't know what it is that we mean when we say Web3. And so maybe we can just start by talking about what is Web3, how do we delineate it from quote unquote crypto or blockchain or DeFi, and first look at that question from the perspective of native on-chain public networks. Maybe Richard, I could start with you on that question and open it up for us.
Yeah, sure. Thanks, Lex. So when I think just at a very high level first, when we look at Web3, I think first it's important to consider how we got there. So looking at Web 1 and Web 2. So I think really with Web 1, obviously, it was back in the early days. You had HTTP websites. And it was all really about sort of sharing information, having your own websites there. You could build your own websites. And that basically was, in a nutshell, you had email obviously come on board. And that was the first iteration of what we now know as the internet. From that, you then obviously had Web 2. So I think part of what Web 1 was is that people couldn't go on board, obviously, and online and necessarily just build their own website unless they had coding skills. So Web 2 really leveraged that in terms of sort of Google, Facebook, Instagram, where it made sharing that information much, much easier. So it would build that website almost for you, and you became a user of that website. Obviously, the slight downside to that is that you don't own that data; it's owned by that platform. And so, over the years, this has almost become it's got so far now that there's only like sort of a few companies, I guess, major companies like, as I said, Google and Facebook, that kind of are dominating that space. So I think Web3 really is now being born because people want to share in that community. They want a greater piece of the pie in terms of that ownership. And so it's obviously, that's where it's how Web3 has really come about to my mind. And what does that mean? So as you said, there's crypto native. So people can now have their digital coins. They can store them themselves. And that element of it is very much decentralized. So yeah, I don't know if Sendi or Quentin want to come in.
Yeah, it's great. Maybe Quentin, if we can open up kind of like blockchain digital asset and up into the public Web3 protocols, like what's the distinction between now maybe versus 2 years? Why are people saying Web3? What kinds of things are emerging? Like just the etymology of that, the history of that phrase, and what to you from the ledger perspective represents some of those symptoms.
Thanks, Lex. So first, completely agree with Richard, and I would add on top of what you just said that Web 2 will stay for long years. We'll be okay with that. We'll continue to share information, but this information will be held in a way by this kind of company like Google, Amazon, and so on. And today we've got the opportunity, as Richard said, to own our data, which is a new opportunity, a new chance we didn't have before. It can be cryptos like your digital assets. Later, it can be your identity and like your medical stuff, I don't know. But this new opportunity comes with responsibility. Meaning today, if you log into your classical bank account, if there is any issue, you can go for a final user. You can go down the street, go to see your bank and say, okay, I've got no money on my bank account, which is not normal. Can you give me back my money? And it will be done in 24 hours. So you're not responsible anymore of your assets. With the Web3 and decentralization, if you lose your key, if you lose the key that allow you to own your money, you lose everything. So there is a danger and point of failure around this, but it comes with responsibility, which is really important in my mind. And what do we see at Ledger is we provide in the most secure way, so through an hardware called Ledger Nano, if you know, an access to this Web3 and to this ownership in a secure way with a secure chip, which is the most secure solution today. But this is not the only solution. You can have a software wallet that allows you to go in the Web3 and own your money, but it's a bit less secure. So the main message here, and because it's mostly on financial, on final consumer, but it's also the same for financial institution, because we're talking to finance leaders and CFOs. If you want to hold assets, whether it's for consumer, whether it's for an institution, it comes with responsibility. You have to secure it, store it, not to lose it.
Gotcha. Sendi, if you'll forgive me for laying a little bit of the rails before handing over to you. I think it's just important to point to this evolution that we've had from, there are things that are crypto assets like Bitcoin, where people primarily think about crypto assets as stuff we can trade, and maybe you believe in the stuff and maybe you don't, but that's kind of phase one. Phase two is let's say computational networks, large computational networks of a kind that's different from running software in the cloud. They still run software, but they run software on different architecture. And so these are blockchain protocols. And in particular, when I say like public, it's things that that anyone can join and support and validate or mine and so on. And these networks run software. That software, can be in the dozens of billions, hundreds of billions of value. And so you have a public financial sector essentially. And if you think about the DeFi waves or the NFT waves, those are kind of narrow ways to look at economic activity on chain. And then Web3 has become a much broader brush. That is a realization that actually these protocols, they're not just about some things you can trade, and they're not just about kind of transforming a particular sector. They are a way to have economic activity on the web such that it's no longer just a web of information and media, as Richard and Quentin laid out, but it's an economic web where you can have digital transactions, you can have digital value, you can have goods and services being made and owned, and you can have economic flows. And so, that term has kind of evolved a bit from the early crypto roots. But that's not the only thing that's going on. And there are some really fundamental innovations also in the private world, in the enterprise world, in the bank world. And I think Ripple has some of the best views into the types of transformations that are happening there. Sendi, could you expand for us a bit kind of what you're seeing around the enterprise blockchain themes, as well as just more generally, how do institutions think about Web3 and crypto assets?
Yeah, absolutely. And I think I had a good sort of broad description of Web3 from everyone on the panel. And I think to introduce sort of another terminology, right? We often talk about Web 2.5, actually, that we're potentially somewhere between. We're at still very early stages of Web 3. There's a lot of things being, whether user experience improving, on and off ramps improving, some of the technology, obviously scaling challenges we're going through. There's a lot of new infrastructure coming out. So we're still in the early stages and really exploring different business models, etc. And where we see maybe some of the more tangible benefits and day-to-day applications is maybe that's kind of the where Web 2.5 comes from. And that's where essentially, in a way, I would characterize as kind of where we've mostly worked with, as Ripple, because really from early days, what Ripple has done is looked at, okay, what problems, right, can we solve with this great blockchain and crypto technology? And we've been around for 10 years. So we've seen a lot of that evolution from, being crypto Bitcoin being a very sort of a bad word that you shouldn't even announce, to looking at now very openly opportunities and even considering again crypto in the flow of payments from very established institutions. And we've focused on that sort of cross-border payments challenges around, again, the traditional method, which I'm sure the audience will be super familiar with, is the correspondent banking and SWIFT, which is the infrastructure that has been built essentially before the internet was even created. And it is not really fit the way we live today, which is so much more on-demand, digital, and global, obviously. And Web3, in a way, the way I see it is essentially going to, it's just the more evolved, expanded phase of where we live more and more in between those virtual and kind of physical realities, enabled by a number of technologies, not even just blockchain, of course. And what we're seeing essentially kind of at Ripple from institutions, again, maybe even 3-4 years ago, it would have been very, very challenging to have a conversation with a very established bank, payment service provider around, having a digital asset in your payment flow, talking about benefits. But today, we're seeing that is becoming more and more accepted because of all the benefits, right? Because, again, I mean, in our solution, we use specifically XRP, which is the digital asset, the native digital asset on the XRP ledger, because we believe it is best suited for this kind of payments solution. And what that allows is for basically payment, the value to be moved almost instantly across the world, everywhere, without having to pre-fund accounts and different currencies in different markets, and therefore locking up capital. And that creates a lot of benefits, not only to, for example, to payment service providers who might be moving money for, migrant workers or small businesses, but as I mentioned, also for corporate treasurers who are looking at that as a way to better manage their working capital and make sure they have the currency where they need it, when they need it.
Absolutely. I think there's the space can be quite complex to pull apart because there's just so many different value propositions. So I'll make two distinctions and then move on. I think the first distinction for folks to keep in mind is the difference between like how a company behaves if it's a business in Web3, like its financial operations, its flows, its income statement, and so on, right? If you're trying to build something and your clients are using crypto assets or just digital assets or tokens as currency, and then number two, there is the issue of how do you think about being exposed to the asset class? So if you're Michael Saylor and you keep buying Bitcoin because Bitcoin forever, that's a different type of thing than if you're Coinbase and you take a spread denominated in 100 different, or if you're ConsenSys and you take a spread denominated in hundreds of different tokens. So that's one distinction. And then the other distinction, I think you already see it emerging in the panel, is the one between traditional companies that are building into the new economy and that have traditional financial functions for it. And then number two is new economy projects, Web3 projects, that all of a sudden realize one day we need to have grown-up financial functions. So again, these are going to be quite different issues. So I want to get into much more detail and I kind of group in my mind two different types of things we can tackle. And the first is money in motion and payments, right, which will connect into those issues around net income, around payment operations, around payroll, and so on. And then separately, money at rest and things that you do with a treasury in this environment. But let's first handle things around payment operations. So, to set the stage, let's say you're a business that maybe has Web3 contractors and you need to pay them in tokens, or you need to pay them in assets and they need to convert their tokens or whatever it is. Or maybe you have a brokerage and you need to figure out, how to actually hold in custody and cash out or hedge this stuff. So maybe, Quentin, we can start with just what kind of infrastructure do you see for payment operations across the different actors that I've pointed to? Like, what is the stack? And the truth is, it's like it's spread out and it's hard to build. But what are the things that you've actually seen work?
Thanks for the question, Alex. So first, I don't want to kill the party, but we have a traditional finance department. So there's no funny thing around Web3 except new asset classes we have to book. But I already have like accounting department, FP&A department. The only thing is that at Ledger, we get revenue in crypto. We are paid by customers in crypto from transactional services we offer on Ledger Live, which is a software linked to the hardware we sell. And so the revenue is directly in crypto. So for example, if Sendi is doing a transaction from ETH to Ripple or BTC to Ripple, we're gonna get revenue in Ripple. And the only new thing in the finance department that I had to develop is the finance linked to data and blockchain. Like a traditional finance department is not able to book revenue from the blockchain on a daily basis. They don't know how to do it. Data team, like blockchain data team, they know how to be linked to the blockchain. They know how to take all the transactions, and this is thousands of transactions per day, and to get the counter value on the blockchain with like information from CoinMarketCap, Kaiko, or provider like this, information data, and to get the revenue countervalued in fiat. Because today, I don't know for Parity and Ripple, but I think that's the same situation. In France, you're not able to provide your financial statements in crypto yet. So you have to book a counter value, and you need to track it. You need to show that the blockchain can justify and can show that you're right in booking your revenue. And this is a new way of doing revenue recognition and doing finance. And we were talking about payments. For us, is getting paid by our customer. So the payment process, there is no stack except the blockchain. We directly get the money from the transaction on our wallet because it's blockchain. It's an on-chain transaction. So it's quite easy. But I would say the innovation in the financial department around that is that the traditional finance department cannot book this kind of transaction. So it changed the function, it changed the department. And I would say that, and my call is to say, and I had many discussions with CFOs, but data team or the new FP&A team, but with a bit like steroids, they're more powerful, they can get more information, and they can book data quicker. And if you miss that, all your financial statements will be wrong. So this is on my side, the innovative way of doing finance at Ledger.
That's a really interesting. That's a really interesting comment. And just to answer like a very basic question, how do you get what is it that you're running to receive the payment? Like, I assume it's Ledger just for lots of chains. Like, how do you get the money? Where does it go? And that question for you or for Richard or anyone who receives a native token, like, where does the thing go? And where is it? How do you get it?
On our solution, basically. So we've got treasury in crypto, and we've got two offers. We've got one offer for consumer and one offer for financial institution to custody and store your assets. So the money, as it's an on-chain transaction, the money goes directly to a wallet, and then this wallet goes to our wallet. So everything is like processed automatically because it's on-chain.
Yep.
Which in a way more secured than a traditional finance flow where you have to do an invoice, send an invoice again with a reminder, go through a process of cash collection to your customer. You kill all of this part of the process with the blockchain. So in a way, we use blockchain to get revenue, but it's native. It's not. We do not use blockchain technology to achieve something. It's the blockchain technologies that help us to get the revenue.
Mm-hmm. I think there's an interesting point in what you said also about, you can't book in crypto, and this point around either knowing what your revenue is in dollar terms, or trying to forecast cash flow and trying to create high quality financial statements while the markets go up 1,000 times and down 95%, every other day. So Richard, Sendi, do you come across this in your roles, and how do you plan forward, or how do you help clients plan forward when the underlying asset is so wiggly and volatile?
Yeah, I'm happy to go for a bit on that, Lex. So I guess when you think of cryptocurrencies in general, everyone has broadly categorized these assets into intangible assets because they can't really fit into any other bucket, right? And so, but when we look at intangible assets, these traditionally have been things like goodwill and patents for like drug companies and things like that, which traditionally are kind of impaired or amortized over time, and generally speaking are not marked up. So the accounting standards that we have today and things like that aren't really defined appropriately to handle sort of the cryptocurrency nature in terms of sort of volatility and what you were just talking about now, and also in terms of like an active market, because traditionally, like I said, for goodwill, there hasn't been an active market. So we're at this kind of stage where we're trying to force cryptocurrency into this intangible asset sort of accounting standard, but it doesn't perform in the way that those traditionally have. And so what we're seeing, certainly in terms of volatility, is that you have a couple of options under sort of accounting standards for intangible assets. You can either mark it at cost, or you can mark it using the revaluation model. And the revaluation model, I guess, in terms of what you do for that, is you revalue it every month. And as we've seen, it obviously has been very volatile. So whereas a cost basis, you obviously just mark it at cost. And if you were to sell that asset, you would take any gain on sale to retained earnings. And so I guess there's an accounting way and a tax way aspect to this as well. So, how does the taxation work for unrealized gains and things like that from HMRC's perspective in the UK? So it's still things that need to be worked out. Just one thing just to sort of comment on in terms of payments and things like that. So one thing we do at Parity is we obviously hold DOT and Kusama on our balance sheet. And we do sort of reward our employees as well with some of those tokens. And the reason for that is because we want to feel like our employees here to feel empowered as part of the community. And I think that's kind of a really important aspect for us, certainly at Parity. Yeah, so at that point, I'll just pause and pass on to Sendi.
That's great. XRP is a big asset, and it also has different prices at different points of time. And you've talked, Sendi, about the importance of liquidity, the importance of having a lot of liquidity if you are going to support clients within payment networks. What's the impact of volatility on being able to provide a product, as well as just more generally, like how do you talk to clients who have concerns there about that issue?
Yeah, I think what I would say is, I mean, the beauty of how we operate, particularly around this sort of on-demand liquidity solution that we use, where we use XRP as a bridge currency essentially to move fiat around the world, right? Is really giving the benefits of blockchain technology and crypto to our kind of very traditionally operating finance functions, and again, heads of treasury, CFOs, typically our clients, without any exposure to that volatility, right? We take on that risk, and we use our expertise that developed again over the last sort of 10 years to make sure that we source the right asset from the market at the right time. We again, we very much obviously believe in transparency is a very important topic, well, in any industry really, but especially in this. And, we publish on our website, for example, our markets report where we disclose all the purchases and sales of XRP. But I think, again, the beauty is, like, it's actually interesting. A lot of times when I speak to our clients, they say, well, don't even tell me you're a crypto company. I don't see you as you are, you help me do cross-border payments better, make sure that I have the right currency in the right company. And you provide me the technology that is on the back end that allow those benefits. So I think it is a really interesting way of bridging, again, that sort of traditional traditional finance world with the crypto world, in a way that, again, brings those benefits of not having to park liquidity, manage working capital better, and not having to rely on, again, constant forecasts and estimates and the operational burden and headache of, having to know how much fund to park where, dealing with T+2-3 day kind of settlement times. Literally, you could be a treasurer sitting anywhere in the world and manage your global treasury operations pretty much at the click of a button, anywhere in the world. And again, you're not exposed to the volatility of XRP or any other digital asset.
So that's really interesting and goes back to the distinction we made earlier between traditional companies using crypto native technologies and then crypto native projects building out financial functions. You can hear Richard say, having access to DOT this is why people want to work here. Like, we want to use our token. The volatility it's not a bug, it's the feature. Like, I'm not saying like we want 150 different currencies to float against each other and have a headache and so on, but we kind of sort of do. That's the emerging way. And then you can also hear the counterpoint of like, hide the crypto rails. They're scary. There's like regulatory exposure. So like, what do we do with it? Like, let's smooth it over with a client experience and really focus on the value proposition. And neither is right or wrong. They're just different parts of the industry. Okay, so I want to switch tracks now to the money at rest. We've moved it around. We've had trouble projecting it. We've had trouble figuring out how to account for it, but end of the day, it does end up sitting on our balance sheet. And so let's talk about things relevant to treasuries, to the management of treasuries and the problems and opportunities that arise out of there. And so, Quentin, I'll go back to you again for the basics. If you've got stuff in the treasury, what does custody mean for crypto assets, number one? And then what does market structure mean? Maybe we handle that thereafter. But how do you hold it, and what market venues are around for you to do stuff with it?
Okay, thanks. So first, how to buy crypto before custody it and before managing it. So if you want to buy crypto, you need to create an account on an exchange and go from fiat to crypto. So you'll open a wallet on an exchange to buy crypto. Okay, whether it's a final user, whether it's a company. When you buy it from an exchange, you won't own it. Okay, you don't have the 24 words linked to your wallet. The exchange, most of the time, will hold your coins. Okay, if you want own it, you need to get a wallet, whether it can be from ConsenSys, a MetaMask wallet, whether it can be a hardware wallet, but you need to get a wallet with the 24 and 12 words to hold your cryptos. And you're going to send from the exchange wallet to your wallet, your crypto. Then you got it. And then there is a question of security, if it matters to you. But what custody means, custody is just, I would say, it's secure and own your crypto in a safe place. But custody is not all the time by you. It can be like, you can go to a big exchange that will do the custody for you, and you can own on your side. So custody means secure and get the crypto somewhere, in a way. So this is Cryptolib. And what does it mean for a financial department? It means new asset class to book in the financial statements. And we talk about volatility. So it's very hard to manage liquidity, the volatility in crypto. You can move your assets to stablecoin, and you can like stay on the Ripple or on Bitcoin, but you will be exposed to volatility. So you have to do reevaluation on that from your balance sheet, whether it's cash or cash equivalent, or whether it's going to be in your assets in the balance sheet. And it's a tough work to do on a monthly basis, much more than other assets, because of the volatility and because of the low level of the tools we have today for the finance department to go in this kind of good booking,
Mm-hmm. Richard, what's the infrastructure stack for the treasury at Parity? How do you hold stuff? What's the risk management?
Yeah, thanks, Lex. So I guess I've worked on both sides, right? I've worked on both the custodial, using a custodian, and obviously non-custodian. So I would describe custody as more of a centralized solution. So, for instance, you could put your crypto assets with someone like a BitGo or whatever, who would retain that custody, and those wallets would be insured. Or you can have a solution which is non-custody, in which case you directly own those wallets, which is what we have at Parity. So we are really just a company of engineers who are helping to develop the blockchain. So obviously having that technological excellence within the company, we can develop these solutions internally to, if you like, have custody of our own tokens. And there's like a lot of governance that has to obviously go around that as well. Because the responsibility is then all on you to manage that. So we have quite a strict policy in place in terms of multi-signatures on the wallets. So you need at least three signatures to be able to move any money around, and that has upsides and downsides when you need to move money quickly and you need to get hold of people. It's not always easy to do so, but especially in this kind of decentralized workplace we're working in now. But also it has like massive upside. So obviously, if we have that governance and control around what wallets we have and on the keys to those wallets, because there is a sort of an old saying now in crypto: not your keys, not your crypto. So if you store your crypto on an exchange, you don't necessarily own the keys to that wallet. And so obviously, as we've seen in the past, some exchanges can be hacked and you can lose that money. So that is why at Parity we store all our tokens on our own wallets internally.
I feel like it's a good time to make a dark pun about how you wouldn't want to send your assets on a voyage, and you wouldn't want the temperature to go to too hot in Celsius. Custom made joke for those. Yeah, I've shot 2 of my 3 arrows. Ooh, okay, all right. So I want to ask a question about market venues and market structure, and in particular, let's say you've got a treasury and it's $100 million or $500 million treasury, and you've got a lot of DOT on the balance sheet, and you've decided you want to sell 100 million DOT and you want to buy $100 million worth of XRP with that. How does somebody do it? So yes, you can, as a retail investor, I open up an exchange account, and maybe as a novice, I can go through some of that with my assets. Sendi, what are your views on market structure and the market venues that are available for institutions? Because I'm sure for facilitating the payments network, you have liquidity operations to trade, and through that you must see what is the ecosystem out there in terms of the market structure for large institutions that want to go in and out of digital assets.
Yeah. I mean, the kind of market infrastructure for again getting into crypto has been evolving a lot and really improving massively in the last sort of 18 months or so, right? I mean, I think it is interesting. Everybody obviously these days love to talk about the crypto winter and all of that. But again, if you kind of look beyond the headlines, there's equal amount of, again, the big traditional names. I think recently, a couple of big Wall Street giants created an exchange, and all sorts of, other big, again, companies are jumping into the space. So we're not really seeing a massive, slowdown of that, despite, where the specific prices of the cryptocurrencies might be. And that goes in hand with, again, the opportunities are increasing, right? I mean, the way we work with, we have partnerships with a number of exchanges where our customers kind of hold wallets, and they have, they leverage XRP that is held in that wallet. It is, is it the smoothest, right? The on-ramps into sort of getting into crypto world today? It's not, whether that's on the retail or the institutional side, but it is massively improving. And that's mainly coming from, obviously, based on the demand, right? And maybe the demand got a bit hiked up because of the price increases, and especially the pandemic and all of that. But we see that not disappearing and really continuing. And again, I mean, to my point before, right, we are at very, very early stages. I think the more institutions want to jump into the space, and they're looking for that, like, institution grade, very secure, right, regulatory compliant ways to access in the right way. And I think one thing that I think kind of a bit of undertone in some of the discussions we started talking about, but the reality is, right, none of, this is going to have a sort of even more mainstream, massive take up, unless two things in place. One is accounting standards, right, which actually they've, Quentin and Richard talked to, and, I'm not so close to it, but it has to absolutely be in place. And the second is obviously regulation, right, which is a very, very important sort of underlying current here, which we've seen that increased focus from regulators around the world, and seeing anywhere from sort of outright bans like in China to a bit more like regulation by enforcement in the US, and a bit more holistic, more comprehensive frameworks like we see in Europe with the markets in crypto assets, which is literally the largest initiative ever to regulate crypto in a very harmonized fashion. And unless those are in place, right, I don't think we're going to see like every single institution jumping in, even though despite all of the challenges they are trying to, and they're really trying to explore, how they can take advantage of some of these benefits that again, readily available to them today that I referenced.
Absolutely. Getting through continued regulatory clarity and global standards, and the regulatory work has to be global for it to actually be successful, because these assets don't really have borders, and in that way they're both challenging and fantastic. We've got about 6 minutes to go, and now is a good time for the audience to submit any questions that they've got, and those will make their way here. So if you've got anything that you think we haven't covered and want to give us, please do so now. I'll touch a little bit on market infrastructure, and then we can talk about asset allocation and exposure, again, subject to any other questions that may come up from our audience. So around like trading and market infrastructure, I think there is an important distinction to make between centralized but more just traditional or regular or normal companies that are in the business of what is essentially prime brokerage. So you have custodians that build from the custody layer up into exchange and capital markets and brokerage. And so you'll see large names that folks know, whether it's Gemini or Galaxy or the companies of that type who are in the business of doing block trades and generally capital market services for crypto assets. So you can execute as a finance team, you can execute entirely with traditional counterparties that'll look like working with any investment bank. You can also go the other way, and I'm guessing in the world of Parity, maybe you're exposed to this more. into decentralized finance, where the market making, where the lending and the trading is all executed through smart contracts on chain. So it is possible to live entirely in the world of robots and in fact interact with nobody other than mathematical algorithms, which can be good and bad. They tend to be resilient, but they also tend to have mathematical bounds that sometimes aren't enough for the liquidity that large organizations have. So I think it is, if we're talking about Web3, Web3 does have its own financial ecosystem on chain, but then it also has a very broad and deep ecosystem off chain with brokerage companies. Okay, if we look now at some of our questions, let's see. What about fundraising? I think we haven't talked about. That's something that's gone through the questions that we haven't talked about. How do you think about tokens, about fundraising, about regulation, about sources of capital? Like, does that come up in your operations at all? Question to the broad group. Sources of capital, using tokens for sources of capital. Is that normal? Is that going to continue? How do we think about it?
I mean, it's not so much for me, but we raise capital, but in fiat, and maybe I mean the question is maybe trying to refer to an ICO, right? Like fundraise with token. I don't know if it fits fashion anymore on the market. We don't talk about it so often, so maybe Richard and Sendi have best view on that, but yeah, you had big view. I don't have big view on that topic on myself.
Were DOT or XRP sources of capital for the other companies, and is it a good way to fundraise? What are the challenges and benefits of having done so?
I guess from our perspective, Parity was, without going too much into detail, was well, we were allocated some of the tokens from the initial ICO by Web3 Foundation. So that is why we obviously hold it on our balance sheet. So from that perspective, we've benefited from the massive sort of upside. I think it was topped out around sort of £50 at the peak. And I guess it has been quite volatile, but we're in a situation where we work for a client. So we obviously have fiat cash coming in through invoicing, etc. So we don't necessarily need to rely on those aspects to raise funds, because we still receive cash, obviously, from the services we provide. But it's yeah, I don't know if Sendi, you've got anything else on that at all from your perspective.
Not really. I mean, this is not top of mind for us at the moment. We're in a strong position, continuing to grow. So not really top of mind at the moment.
Got it. Okay. So what that tells me is that, when we talk about Web3, we talk about an operating economy and really businesses that are focused on their cash flows and their income statements. And being able to raise through tokens is absolutely available to participants, and that continues to happen, whether it's an ICO or through automated market makers. And it certainly does fund the operations of most major protocols, regardless of kind of the current focus. But the way out isn't through fundraising. The way out is through building useful businesses that are compliant, that have reasonable unit economics, and that add value in the long run. So with that, let me thank our panelists for spending time with us, and thank our audience for your attention. Cheers.
Thanks, everyone.
Thank you. Thanks, Sarah.